So chart patterns are designed to tell you if either the trend will either continue, or what's called continuation pattern, or change or reverse, a reversal pattern. And in this section, we're going to talk about continuation patterns. So you're going to be seeing trends, you're going to see things continue along the trend. So kind of keep that in the back of your mind. We're going to be talking about continuation patterns in this area, and then later we'll be talking about reversal patterns. But reading right from here, you can kind of see that one of the key kind of parts of this is there needs to be a trend, right? For either one. If there's no trend, you really have no continuation or reversal pattern. That's been fully formed. You might see one a pattern in development, and you might be a trend be in development too, and you'll see that as we go through the lessons. But one of the key things is part of this whole trend is your friend, and the trend is going to help you as an indication and a predictor, and the patterns do that too, but they need that trend to be there as well. So that's where with chart patterns, sometimes they take a little patience around that because you're waiting for these things to develop. So in an established trend, what happens is let's say it's an uptrend, there's a trend that's being established, prices are headed in a certain direction, that's what we mean by trend, prices are either going up or down, and and what can happen is there's a pause. There might be the strong trend either way, either up or down, and then there's a pause, a little slowing down of buying and selling. The trend is starting to lose its steam, so to speak. It's not as being firmly bought up or firmly sold off, so to speak. So it's starting to lose its steam. And when you see a continuation pattern, that is indicating that the trend will accelerate again after the pause. So let's use that example of an uptrend. Let's say you've got an uptrend going up, there's a pause, so prices kind of stabilize or go sideways, maybe down a little bit, and then with a continuation pattern, they would keep going up is the idea of a continuation feel good. And when you are, let's say, investing off a trend, and you see a pattern that's there, you can feel good that you've identified the trend correctly because it's a continuation trend is the idea. So you can feel good about that, okay, I have a really good handle on this particular security, how it is trading at this moment in time because I see the trend, but I also see the continuation pattern kind of reinforcing that. And we can make trading decisions around that as well. So when you're thinking about trading and you're trading continuation patterns, if it's an uptrend, prices are rising, you don't want to sell it. You want to ride that price up further. Hopefully you bought in at some point lower, the prices have gone up, so you've made profit as the prices have gone up, and you're seeing this pattern, you maybe see a pause, but you see a continuation pattern, and so the idea is that it's going to keep going up and you'll get even more profits off of that initial trade. In fact, what you could do in some cases is you see that, you could add even more to that trade, keep investing a little bit more in that security. Not only do you have your original investment, but maybe now you see this chart pattern and a continuation pattern is formed. You can even add a little bit more or add more, and now you've got even more money that's as you adjusted your position to kind of ride upward in an upward trend. Now if you're, let's say, looking to buy as opposed to short selling or other types of strategies out there, but let's say if you're buying securities and you see a downtrend, well, you can see that established downtrend, and you need to continue to wait that out and wait out that downtrend before buying in, right? So it's a good way to judge to see, is it going to reverse? Is that downtrend going to maybe go start into an uptrend now? But with a continuation pattern, it would be like, no, I see a continuation pattern in a downtrend. That means it's going to keep going down further, which might mean we might have a great opportunity coming up in the near future once that continuation pattern basically runs its course. So that's a general idea behind continuation patterns. Let's now look at some specific examples of the actual patterns that you can see and how to trade off of them. In terms of chart patterns, one of the more common ones you'll see out there are triangles. And really what's happening with there is there's a converging of a support and resistance levels. So think of, again, I think of support levels as prices don't go below a support level, they're bouncing off the bottom. There's a level where they're not breaking through or going lower. And a resistance level will be at the high part of prices where prices maybe are marching up to a resistance point, but they don't break through that resistance. They kind of turn around and start coming back down. And they're trading between these support and resistance level. But with a triangle, these things are starting to come closer together. They're converging is what's happening. And you can be either in a rising or declining prices. The trend could be either going upward or downward. And so what's happening is the trading price range is starting to converge or narrow. Maybe it started out here and then it started to get narrower here, and it actually forms the shape of a triangle, as you'll see in the upcoming lessons here. And then what happens is the breakout, when it breaks through one of those lines, either a support level or a resistance level, when it actually breaks through those and then starts going further in either direction, whichever way it's going to go, it usually will break in the direction of the original trend with a triangle. That's very important. It'll break in the original direction of a trend with a triangle. So if the original direction, let's say upwards, and the triangle forms and starts to converge, then if it's an upward trend, it'll break through that resistance level at the top and then break through to higher prices, because an uptrend is higher prices. So if we bought here and we're starting to see a nice uptrend and a triangle forms, that's a nice pattern to kind of stick in there and let it break through that resistance level, and we'll be seeing that. So because think about, again, as chart patterns go with triangles, they are continuation patterns, and that's why you'll follow whatever way that original trend is, either upwards or downwards, because it is a continuation pattern as opposed to a reversal pattern, which would go the opposite way. But these are continuation patterns, as you'll see in here. Look at, let's say, not at the very beginning, but kind of start at the middle. Do you kind of see, if you look at the highs and the lows, if you were to draw lines connecting those high highs and those low lows, does it look like it's headed in a certain direction? Does it look like a triangle is forming? And it's not like I believe the word is isosceles triangle, all the sides are equal. It'd be more of I believe a equilateral triangle. Boy, it's been a long time since I talked about that. But the idea is that a triangle is forming here, and do you see it? Well, let's put in those resistance and support lines here, and now hopefully you can see the triangle as it's forming here, and you can see that higher highs were not made, but the uptrend is going to continue on this. So and the prices don't reflect new lows either. They're trading within that resistance and support line, those lines up there, and you can see how they're converging together, they're getting closer together. So if we start at the far left of the triangle where that dotted line is, and then you can see how the prices went up to that resistance line, but didn't keep going. The uptrend didn't keep going. It turned around and went back downwards. So now it's going downwards, and then it hit that support line, but it didn't break through there either. It then turned around and went back up. And there's always ups and downs as you go throughout, but it then marched back up to that resistance line, and so on with multiple touches. And you can see how the trading range narrows. So that is what's called an ascending triangle. Ascending because it's an upward trend, and the triangles, the bottom line, that support line, is sloping upwards, where the resistance line is more horizontal there. So that's an ascending triangle, which is a continuation idea. And so when you buy on this, so you're buying when it's getting to that low, it's getting close to that support line, right? So you want to let the trend develop. You want to let the triangle develop. That's the key thing with patterns. You don't want to say, oh, I first saw it, hit that first touch of that line. I'm buying then. We don't know yet whether that's going to kind of reverse around. So typically you want to buy in like the second or third touch of a support line. And the more touches a support line has, the more approaches or close or near touches it has, the stronger the indicator is that that trend is holding, that those price levels are holding and then becoming more predictable. In this case, we've got, you can see where we started to the far left, kind of where the dots are, and we got 1, 2, and we look at the third one where it's approached, and once it makes that turn away from that at the third one, that's when we buy in, right? So that's a very strong confirmation. You can also use a second indicator to further confirm, with volume or a moving average or some other type of indicator to help you confirm as well. You don't have to trade just off the triangle. You could buy on that second touch, by the way, and that's perfectly fine. The third touch just gives you a little bit more confirmation. The more touches, the more confirmation. And the idea is we bought there on that third touch. It went up a little bit, actually then came back down and then touched again for a fourth time, then went back up again. But you can see with that support line there, we've established the support line. The third touch helps support that support line, and then it actually reinforced with the fourth touch there, and then the prices went up, and you can see our profit between where we bought. And if we wanted to sell at the top of that resistance line, we could, or if we wanted for it to turn back around again, we could hope for another touch of that support line. But if you see in this ascending triangle, you see how everything's getting narrower, the price range. So now it's getting a little bit more closer as far as will it turn around or will it resist, or will it break through that resistance line, or if it goes back, will it break through that support line because the triangle is converging. It's getting narrower. That's the whole idea of the pattern. And because it's a continuation pattern, we have a better chance of the breakout, of course, happening. And the whole idea is it's going to break out on the top end because this is an ascending triangle. Prices before were rising, and then they got into this triangle pattern where they went up, they went down, they went up, they went down, and then started to converge. And as they got tight and converged, then somebody had to win. The bulls or the bears, somebody had to win. It had to break a resistance line or support line one time. And since triangles are considered continuation patterns, your breakout is going to be in the direction of whichever way the trend was, and the previous trend was an uptrend in this example, or an ascending triangle. It is always a breakout to the higher end because you can see the support line has an upward slope to it. So that's where your breakout is. Now in a descending triangle, it's the same concept, just the other direction. You see how our support line now is horizontal, and our resistance line has a slope, and it has a downward slope, and a downward trend leading into it. Again, it's a continuation trend. So the lower lows are not made, but the downtrend will continue as it trades within that and it converges in there. But the prices are not making new highs either. The prices are starting to narrow and get closer down. So really to tell whether it's an ascending or descending triangle, you'll look at which line is horizontal, basically straight across, and which one has a slope. Ascending, going higher, would have a resistance support line, that's uptrending, and a descending triangle would have a resistance line that's downtrending or downwards sloping. So if you own, let's say, if you own something, you might not buy or sell your holdings depending where you're at within the triangle. If let's say I had bought earlier and it was downtrending, but I had bought earlier, and I had it where it starts coming back up within that triangle, I might try to sell near the resistance line, really to just get out is the idea. Because again, a trend is going to start, it's going to keep getting lower each time it bounces between that resistance and support line. The prices are going to keep getting lower until eventually they break through, and they're going to break through in the direction of the trend. Though anything can happen, some kind of unusual event, things could happen, something that that would break the pattern that way. But if following the normal pattern, it's going to break out to the downside because that's where the original trend was. And you can even see within the triangle how it's converging towards the downside. Prices get lower and the range gets more narrow as we go down, so it'll break out to the downside. So when you see a triangle forming, the first thing to identify is it an ascending triangle or is it a descending triangle? And then you can base your trades. You can watch that, let it form. You can base your trades around it. Again, with either triangle type, you want to at least touch or get near that line that's approaching at least 2 times to help confirm that this is a real pattern that's in formation, that's in development. A third touch is even better, and the more touches you have, in general, the more formed the pattern is. Though you might be missing out a little bit if you wait too long. So usually like a second, and certainly a third touch is a good recommended best practice when you're trading within many of these chart patterns, or almost all these chart patterns, but certainly with triangles. Another continuation pattern that's going to follow the trend either upward or downward are what are called flags, right? And it's a continuation pattern, but has a dramatic but brief reversal, and it's a real dramatic reversal. So if your prices are, let's say, downtrending and they're going down on a flag, it's going to reverse and go. The prices are going to go dramatically up for a little bit, and then they're going to come back down and follow that reversal. So we'll see an example coming up. And the whole idea, like a lot of chart patterns, they look like something, and that's how they get their name. So it looks like a flag, or like a pennant on a flagpole, right? And it's similar to a triangle as far as it's got a shape and all that, but it really kind of looks like a pennant or a flag with a flagpole. And then what you're seeing is a sharp rise or fall, depending which way the trend's going. It's going to go the opposite way for a short period of time with a sharp rise or fall, depending, and going the opposite way of the trend, and then pick up the trend after that. And what you'll see also is that the pole part of it, that's where trading volume is. That's where you get this spike up in your chart where you also see this a large amount of trading volume. A lot of people are trading, they're buying and selling the security very frequently. So you see a large, trading volume at the base of the flagpole, and then your pattern could either be at the top of the flagpole or at the bottom of the flagpole. But it's the idea of that volume is what's making your flagpole. So if we were to look at this chart pattern, and for fun, I threw in an area chart. You can see the top there, the peaks of these mountains are the prices, that they are, closing prices that they're at on this chart. And along the bottom is volume, represented by green would be an up day and red would be a down day as far as the trading on that particular day on this particular style of chart. So you can see the prices, then look to the bottom as far as the volume. And if you look from left to right, not much is happening, though it does look like we're in a definite downtrend. And as those bars get, on the horizontal bars, the volume, the trading activity, you can see there's a big downward dip as far as the trading activity that goes there. And then all of a sudden it reaches a bottom and then it shoots back up and then continues the downtrend. And if you can kind of see where those green bars are, if you start envisioning a flagpole there, start envisioning that there's a flagpole, there's going to be a reversal of the dominant trend. And then at the top, we might have something that looks somewhat like a pennant around that. If we add some lines on here, you can kind of see, where it's that pennant forming. It's kind of a triangle. It's kind of more rectangle-ish as far as being more parallel lines. But the green lines on the bottom, which is the spike in trading volume, is one thing you need to be part of a flag pattern. Your flag needs a flagpole, so you can see how it's all of a sudden has this big reversal, shot way up, and kind of forms this flagpole with a pretty big pennant on there. In this particular example, where there's this big spike in profits prices that come up. But then what happens? It starts to go back to the original trend. That's why this is considered a continuation pattern. So if we put the, let's say, a trend line on top of that, you can see that once you get past this kind of flagpole idea, it's going to go back to that original trend. So the way to trade a flag is, let's say you see this dramatic volume, you see this dramatic spike up, and you might be able to trade in there early enough to make some profits and then get back out right away. At least in this one, where we're looking at a downward trending one. An upward trending flagpole would be the opposite around that with an upward trend. But typically when I see flags, and really I see them as more, because I'm used to the traditional look of a flag on a flagpole, I guess it makes it easier for me to see when I'm seeing something in a downward trend and I'm really trying to trade on that upward spike, is how I treat it, how most people do it if they all of a sudden see a flag. Something's happened to cause that flag. That's why the trading volume comes up. There's probably some type of event or some news there. Maybe there's anticipation of a good earnings announcement after a series of bad ones, or if it was a stock, or something's going on in the crypto or forex market if you're trading those types of securities. Something's happened to cause the flag to, that big sharp rise. But then after that event happens, people are like, no, this is still not great security. It needs to downtrend some more. And you can see where it picks back up on that trend. So flags can be, if you see them forming and you can get in soon enough, let's say, especially when you have that sharp reversal for the uptrend before it goes back down again, can be a great way to get a trade in there, make a little profit, maybe quite a bit of profit, and then get out right away because it's getting very spiky there. Just make sure you get out before the overall continuation trend, keeps going back, as far as, pushing those prices back down. Let's say if you're buying in more towards the bottom. Well, if you like triangles, you might really like rectangles. Rectangles, like triangles, are a trading range that are bounded by a support line on the bottom and a resistance line at the top. However, instead of converging, it's more running parallel, forming the shape of a rectangle, as you'll see. And they'll continue along that kind of path, which gives us a lot of good trading opportunities inside the path until there's a breakout of the rectangle. Now, you might say to yourself, well, which way does it break? Does it have a tendency to go a certain way, whether it's going to break through a support line or resistance line? The answer to that, because it's a continuation pattern, is it's going to follow the direction of that previous trend. See how continuation patterns will follow the original trend compared to, let's say, reversal patterns. But rectangles are, by nature, a continuation pattern. So we'll be watching those trends in that overall direction of prices, either up or down, and then we'll see how the rectangle forms, and then we'll see how we can maybe trade around that. So if you look towards the middle of the chart and think about those support line at the bottom and a resistance line at the top, if you were to draw those two lines, and form a rectangle, just visually look at this for a moment, what might it look like on your chart? Where you'd be drawing it on there? Think connecting the highs and the highs together, maybe at the top and lows to lows with horizontal lines. So if you saw something look like something like this, well, terrific, you're right. If not, that's okay too. We're learning here. That's the idea. I just want to give you a little kind of mini idea as we're going here. And you can see in this particular rectangle pattern that there's an uptrend that we're entering into the rectangle into. So in this case, there's a continuation pattern, so it'd be a different direction, which was this uptrend. But then it gets kind of in this narrow trading range of resistance and support lines. It goes up and bounces at a resistance line, which can't push the prices higher. The buyers or the bulls can't push the prices higher, so prices come back down. But a new trend doesn't form. It doesn't turn into a downtrend. It basically stops at that support line and then turns around and starts going back up towards the resistance line, and so on, trading in this range. And how wide the distance between the resistance line and the support line will vary by the security and at that moment in time. Sometimes it can be very, very narrow. Sometimes they can be much wider, of course. So it's not so much of the idea of how wide or narrow it is. It's more that it's actually formed this rectangular pattern. And if we look at that, you can say, oh, well, there's opportunities where I might want to buy, or there's opportunities where I might want to sell within a rectangle pattern. And that's true. We want to make sure that the pattern has fully formed. So again, we're looking to buy in at the number 2 or 3 touch of it. You could buy in, let's say, you can see the first touch there. I don't have an arrow there. The second touch, I don't have an arrow there too, though a lot of people buy in the second touch at that support line. A real good confirming way is to buy in at that third line. You could put in a buy number 1, and then you can wait for it to come back down. It's either going to break through that resistance line at the top and keep going, but if it turns around, there's a really good chance it's going to bounce again off that support line. So once it comes back down, if you're a little bit later or seeing this later or want to be more sure, you could buy at the number 2 position here. So you can buy in a second, third, or fourth touch. If you're looking to sell the security, one thing you can do is do a lot of trading instead of waiting for the trend to go back in a certain direction. You could just trade frequently within the rectangle. So every time it comes up to a resistance line, that's where I'm selling. So I would be buying, let's say, at the support lines, let it have its run up, sell it to take my profits, let it come back down. Right now I'm out of the security. Once it gets down back to that support line and rectangle holds, I'll buy it again, and then kind of repeat that until it breaks through as far as breaking the pattern. But until then, what a nice trading opportunity to trade frequently as far as buying and selling inside the rectangular pattern. All right, so let's say in our rectangle here, where do you think the price will go next, right? I mean, we're now at the top or at a resistance line. It could either break through the resistance line and go, basically go upwards, to where I've labeled letter A, or it could turn back around and go to letter B. Now, we don't really know, but if you were to guess, maybe you'd have an idea of a guess around that. Guessing is not something we do in technical analysis, by the way, but when we're looking at a chart pattern for fun, you can kind of think about which way it might go. And how you can really help confirm that when you reach, let's say, the top or either resistance line or support line is look at your other indicators to help confirm things around volume, moving average, relative strength index, things that you're learning in the course, where they'll also give an indication of like, oh, this is a buy opportunity or a sell opportunity. So use those other indicators to help confirm that you'll learn in the course what might happen here. But let's say I told you it was either going to break either through resistance line A or it's going to turn around and go all the way down and break through the support line B. Just based on what you see here, which one do you think it is? I'm not giving you any other indicators. You just got to go with the pattern here. I'm just telling you it's going to do one or the other because I'm the instructor and I'm having fun, and hopefully you are too, right? Which one do you think it is? Now, a little hint here, rectangles are trend continuation patterns. What was the trend coming into the rectangle? So if you thought, okay, I'm in an upward trend, so I'm going to say A. Well, you would be correct because that is the uptrend was already established before. If the uptrend then went into this rectangular up and down pattern, and if it was going to break through, we'll be watching for it to more likely break through on the letter A there, break through that resistance line and continue our uptrend. So that you can see that if we're say buying at the support lines, and if we're doing frequent trading within the rectangle, because I bought at that support line, once it approaches that resistance line, if it turns back away from the resistance line, I could sell, get out, and then do it all over again at the support line. Or since I already bought at a support line, I could buy again, or if I held it through this whole period, by the way, too, and I bought it way back when on that uptrend, I could then hold on to it and wait for it to break through that resistance line and continue the uptrend going upwards is the idea. Now, if it was a downtrend, it'd be the exact opposite, right? So just think of this rectangle and just the line on the left there flip where it would be a downtrend, and it would break through B, break through the support level, and continue the downtrend, and you adjust your trading accordingly. Now, sometimes rectangles will have that same parallel move between the upper and the lower, the support or the resistance line and the support line. And the key is they're not converging. They're moving parallel together, but they don't necessarily always look on their side like in a sideways market. Sometimes they can trade on an angle or on a slope, either kind of continuing that uptrend or continuing that downtrend. Even with inside that, it's got some movement inside there, and that would be what we call a channel. It's really a rectangle, and there's a channel of prices that are happening. But the idea is it's not converging like a triangle. It's still this narrower trading range, and then we treat it appropriately as a rectangle. Again, triangles and rectangles, continuation patterns. Trend is your friend. The idea is you're going to watch for them to go through. If they do break through, they're going to go in that same direction of the original trend. Nothing's perfect, of course. That's very important, but that's the idea of these chart patterns that have been proven over time. More likely than not, hopefully it's ideal. Continue that pattern. Arguably, one of the funnest names in patterns is the dead cat bounce. And traders love dead cat bounces. It's a continuation pattern, so it's going to continue whichever way that trend has been headed before. And they love it, not just because the name's kind of funny, but it's actually a very good trading indicator, as we'll see here coming up. And they're very rare, actually. When you see a dead cat bounce, sometimes you'll see forums or people who are talking about trading say, oh my gosh, it's a dead cat bounce. And or it seems like it's forming. Watch out, it looks like a dead cat bounce. So you'll see some of that out there. But because it's rare, but the reason that traders love it or like it is it's very consistent. It's one of the more proven patterns out there. It's a very consistent pattern. And it includes a gap as part of the overall pattern. There's a gap in prices, as you'll see when we walk through how this works. And a gap by its nature is a very strong indicator as well. So you have an indicator that as part of the indicator has a strong indicator built kind of right into it. So that helps to make it very, very consistent is the idea of a dead cat bounce. So let's look at a dead cat bounce and how that kind of works, because it's a chart pattern that'll take a little bit of time to form because certain conditions have to be met along the way. So what happens is you see this, we're going from left to right, of course, with our time farther back in time to the right, more recent times, and prices, high at the top, low to the bottom. So what we're seeing here, you can obviously see that there's a downtrend, right? Remember, when we're trading chart patterns, there has to be an established trend. So what we're seeing here, and this is a dead cat bounce, there's a downside breakaway gap. So you can see the three bars to the left, the three price ranges, and imagine before that there was an established trend too. And then all of a sudden there's a downside gap, right? There's a big gap in prices. The lows of the previous day were well broken and went to even lower lows, and we have a gap in prices there. Review or take a look at the lessons around gaps and trading gaps. We'll learn more about gaps, but the whole idea is there's something's happened. There's some type of big bad news or something happened to cause a big drop in prices. And then typically for a dead cat bounce, you want to see a dramatic drop. It's not a small 2, 3, 4% breakaway gap or big drop, or drop. You were looking for something like 25% or even up to 70% drop. You're looking for some really bad things to happen. Your cat is dead, unfortunately. And so you have this big gap. So look for a big gap of like a 25 to 70% price drop. And then it basically forms this it goes in this now new, even steeper downtrend, and then it reaches the bottom of the downtrend and it hits the floor. Your dead cat hits the floor and it bounces. So you see there's another breakaway cap off the bottom where it bounces up, right? The prices have now made a leap up. And it doesn't have to be a dramatic leap up, just that there's a gap that's formed. The idea is that it's gone, you've had a downside gap, things have gotten even worse, it keeps going down, 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 it looks terrible, and then it bounces off the bottom, and then it starts going up. And so it's a short term, the idea of the formation of the dead cat is it's a short-term thing. It doesn't reach the original price gap prices. It doesn't, see how when it reaches its peak, it doesn't go above the prices or above where that original gap was back to the original, let's say 3 downward lines there on the far left. It's going to kind of start to approach that, but then it's going to turn around again. Again, a dead cat bounce is a continuation pattern. So it's going to resume that strong downtrend. But the idea is something's bad happened, drive it down, and people are looking at it as it hits the rock bottom and bounces. They're saying this is way too low. Maybe this has been oversold. Let me buy in, and then that you get more buyers. And that has the bounce. That's your breakaway gap. That's the bounce. So the idea is you want to trade on the bounce, but be ready to get out, right? So you're seeing this happen. It bounces up. You see a breakaway gap. You need a breakaway gap going upwards, not just a trend going upwards. You need a breakaway gap going up to be a dead cat bounce. You trade on that, short-term trade, but you're ready to get out, especially as it starts approaching that first breakaway gap to the downside or approaches the last kind of low in the previous downtrend low. You want to get out and take your profits, because what's going to happen with a dead cat bounce is it's going to reverse, or basically this temporary bounce, this temporary reversal is going to go back to the original downtrend. So be ready to get back out. You kind of have the exact opposite of that, and that's even rarer than a dead cat bounce, which is an inverted dead cat bounce. Just imagine this, but you're in an uptrend, and all the same concepts apply. Is just in an uptrend is what would be happening. Again, very, very rare, but if you see that, you can kind of trade appropriately around that. So the idea of the dead cat bounce is it's a short-term kind of profit opportunity, and that's why a lot of traders like it. Besides the funny name, is they can get in and get some profits, but they're really watching closely for any sign of a turn that might be turning back down to that downtrend, and then they get out right away. With a dead cat bounce, you want to trade on the bounce as it bounces off the floor. You don't want to go back into that downtrend, because the downtrend's going to keep getting worse. It's going to go past that floor and start creating new floors on this bad downtrend. So dead cat bounces are good trading opportunities, but just be aware of how to trade them. That's the real key part, is that you're trading the dead cat bounce. It's not something you'd hold for long periods of time. You're just trying to trade on that bounce, get in, get out, make some profit. A very interesting chart pattern is what's called a cup with a handle. It actually looks like a cup with a handle on its side is the idea. And what makes it interesting is it's not only a chart pattern by nature, but it's combining these price patterns like you'd have in a chart pattern and trends and all that with things. Really, you have to have certain other factors or indicators that are part of that. Volume levels, how much trading and buying and selling is going on, as that cup forms, as we'll see here in a moment. And you're going to use an indicator of the moving average indicators as well too, to help kind of confirm all of this as well. So they all kind of work together. And we'll walk through how all this works, including the moving average a little bit, so you can see how this all pulls together. And it is a continuation pattern. So the idea with the trend, and the idea of a cup and handle is the trend, let's say, is going upward. Cup and handle will form, and the trend will continue is the idea. So it's a continuation pattern and takes time to develop. So this is one that does take time to develop, but when it does, and if it does, it's a very, very strong indicator when it does. We'll walk through why that is from kind of the psychology of what's going on with investors and traders that's forming this pattern. And as I mentioned before, it's fun because it looks like a cup. So if you can start visualizing a cup on its side, not the downward one, but on its side with your cup and your handle, then that's kind of cool, right? It kind of is an interesting thing. So let's take a look at a strong indicator, cup with handle. So if you look at this here, this chart pattern, let's start off, let's see if we can guess. Let's do a little more guessing game. So look at it and just start looking at, you're looking for a cup. So in a cup, let's say you're looking at the side, you'd have a cup that would hold like a liquid, right? So you're looking for an indentation in this chart pattern, these price lines that are going on this upward trend. Can you see the part where there's a depression where you could maybe put some water or some adult beverage if you like? And is there a handle that might be on the, looking at our screen, the right-hand side of that cup, because they're going from left to right as far as time. So that's what kind of the pattern looks like. If I put a little bit of a highlight on there, you kind of see how it's starting to form like a teacup, right? Like it's starting to form a cup around there is the idea. So that's what you're looking for, is that cup with the handle. But to get there, there's a lot of things that got to happen. So let's put a whole bunch of stuff on the chart and let's walk through it. So first off, let's start at the very far left. We've got to have an upward trend, right? And as you can see here, the general direction, if we were to draw more specific trend lines, but you can see that the slope is upwards, the prices are getting higher. There's an upward trend. And then you can see that the bottom of the trading volume is kind of like this medium trading volume that you'd see looking over the history of the prices for your security, whatever trading volume it is. Some securities trade a lot all the time compared to others, but you're looking at this particular securities, horizontal or vertical bars at the bottom. And let's say this, blue part represents that range of volume, and it's kind of a medium volume, right? So it's on a nice upward trend, nothing exciting happening, but it's a nice good upward trend. Maybe we bought in earlier and we're hanging in there. That would be terrific, right? That's maybe the idea. So we're seeing this happen. We're seeing this trend. And then it starts to reach a peak and starts to go downwards, and then it goes down in the cup part, and it starts to go sideways, right? So it doesn't go into full downtrend mode. It just starts to go sideways. The prices kind of bounce up and down a little bit in more of a flat part, forming, in fact, the bottom of the cup. And you'll see the trading volume is low on this. So you can see how they're all working together here, that the trading volume is low. And then as we go back up, you'll start to go back up, and then a handle forms. And that's when the handle forms, and certainly when there's the continuation pattern of the upward trend, we're back to this rising pattern, back to this upward trend. But one key part of that is that the trading volume is higher, right? So all of a sudden, a lot of people are trading it, and they're driving the prices higher. And then all along this, you're looking at this, you want to overlay on this is the simple moving average, or you can use a different type of moving average, like a weighted moving average. Look at the section around moving averages and learn more about moving averages. But basically, like let's say a simple moving average is looking over, let's say, the last 10 days or 10 periods, typically days, and saying what's the average prices. And really where that line comes in there is to form the bottom of the cup. We don't want those to go either too far, but we would rather they didn't break the simple moving average at all. But or only just go a little bit below, just a little titch. We don't want to go way below the simple moving average, because then we don't have a cup. We have more of a downtrend, or we have more of a V-shaped cup, which is what we don't want. We want more of a U-shaped type cup, like we see here. So you're using that simple moving average to kind of help confirm and be a basis on that. And you can see how it follows along with the trend lines above it as far as that simple moving average. So what's happening here? So this is what it is, and you can trade off that, right? You could have either invested in the upward trend and then see the cup form, and you're hoping the cup forms, you hang in there, and then once you see the handle, you really hang in there because now you're going to be in an upward trend. Or maybe you're not in the security at all, and you see this cup forming, and then you see the handle, and you start seeing that sideways move in the handle, then you're starting to trade in there because you know an uptrend is coming, or you're hoping an uptrend is coming because it's a continuation pattern, and so you're buying in at that point as well. So you're either had bought in earlier and you're holding through the cup and handle phase, or you see the cup and handle forming, and now you're buying somewhere in that handle, or most likely you're buying, actually probably better things, you're buying a little bit slightly up in the cup, or excuse me, a little bit slightly after the handle because you want to have that uptrend definitely form. But if you think about the psychology of what's happening here is that we've had this nice uptrend and it's been going up. Well, we're going to start back on the left here, looking at the volume and stuff. A nice uptrend, steady uptrend, buyers are buying, and it's just kind of steady uptrend. And then it loses steam, right? That's what happens to chart patterns. They lose steam, and it starts it's going to continue later, but it starts to go reverse the other way. And then so the prices go down, people are taking profits, and maybe that's what's happening. Prices are going down, but there's a low trading volume. It's not like there's a lot of excitement. It's not like there's something bad that's happened and the trading volume's high, driving the prices way down. It's just kind of like, it's just kind of really getting low volume, kind of boring, just kind of moving along. Moves along the bottom of that simple moving average. The cup is in fact above the simple moving average line, but this cup is forming. But again, it's nothing exciting going on from volume, and the volume starts to pick up, and people are like, oh, okay, well, maybe it's picking up again. And then what happens is those who didn't sell, towards the bottom of the cup might be selling now at the top of the cup or along the handle, right? They can't decide which way to go, the buy, sell. There's a little bit of movement, but now there's more trading volume coming in. And so that's starting to move that handle a little bit. It might actually, start ticking up a little bit just itself. It doesn't have to be a fully horizontal handle, but it's going to be, and it usually isn't, in real world. But it's what's going to happen is you're going to start to have this high volume and you're going to have this upward trend. So that's kind of, and then people are like, oh, this was just a temporary setback, that cup part, maybe a pullback. If I held on, I'm just going to hold on and really now ride this upward trend. And other people are like, all right, they had this temporary pullback, handle form, indecisiveness at the handle, definitely went into uptrend, and now I'm back in buying because I know that uptrend is going to keep rising above there. So that's kind of the psychology behind a cup and a handle. Also, one thing to consider too is the longer the U shape of the cup, the more it's more predictable than a V-shaped cup. So if you see that that we have this long U there from in the example that we're showing here with this cup, it looks like a U, but it's really kind of flatter and longer than if it was a real sharp V type of a cup. Also, the cup shouldn't be overly deep. The idea is you've had some indecision, you have some profit taking, but it shouldn't be driven way down low. It should certainly not be driven below the simple moving average line. That's what helps us with our cup. So it should not be overly deep. If it was really a deep cup, then it might be people are not as indecisive or taking profits. They might be an actual real trend reversal, and it's not really a cup and handle. It's actually something different going on. So look for U shapes, longer U shapes on the cups to be more confirming, and then also look that the cup is not overly deep on it, and that'll really help you well. So you probably saw there, you're saying, wow, that's a lot going on with a cup and a handle. It looks nice, but I got to really wait for that pattern to develop. And that's true. And you have to let it develop. But as you can see, there's strong indicators and multiple indicators on top of indicators, so that builds a great trading opportunity. So it might not be something you're trading every day, but if it kind of jumps out at you and slaps you in the face, like you might want to take notice of it because it could be a great trading opportunity and to ride a long-term upward trend after a pause there in the cup. So chart patterns, as we know, are designed to tell you if either an established trend, that's key that there's an established trend either up or down, and will that trend either continue, a continuation pattern, keep going the same direction of the trend, let's say it's an upward trend, it would keep going upward. Things like triangles, rectangles, dead cat bounces are continuation patterns. And in this upcoming lessons, we're going to talk about reversal patterns, where you're not going to continue that trend. In fact, the trend is now going to reverse. It's either going to go sideways or it might completely reverse and go, let's say if it was an uptrend, it would go downward. And if it was a downtrend, it would reverse and go upward. Obviously, we can see that if there's a reversal pattern happening, we might be waiting for that trend to happen and for that reversal to happen. And then that might be a good opportunity to either buy in for a reversal that's going to lead to an upward trend, or maybe we're selling at more of a peak, let's say to when a downtrend or an uptrend is going to reverse to a downtrend. So either way, the idea of a predicting nature of an indicator is very, very powerful. So we're going to talk about in this section, reversal patterns, the trend is going to reverse. So as we know, in an established trend, there may be a pause in buying and selling. That's the same with a continuation pattern or a reversal pattern. The trend is starting to lose steam. And when you see that reversal pattern, that is indicating the current trend will end and a new one is beginning. And so we take appropriate action based on that, depending on which way the trend was headed in the original direction of the trend, and then it's now going to reverse. So let's take a look at some of these different types of reversal patterns that we can be watching for. All right, let's get a little alphabetical, right? So one of the more popular, or common, I should say, and popular trade on patterns is a double bottom chart pattern. And they're more common than a lot of other types of chart patterns and double bottoms and double tops. But let's talk about double bottom chart pattern. Basically, it's going to look like the letter W, right? And what's happening is you have a downward trend and it's retesting of these lows at the bottom of the W. And the idea is it's going to predict a price breakout. It's going to break out of that trend or reverse out of the downward trend and going to break out to the upside. That's the idea. It's under certain conditions, we're now going to break out to the upside. So let's look at that and how those form and how we can trade off of those. So if we look at this example, this is all the prices high to low, made into a line chart here, and it looks like a W. Do you see the W there over on the left there? And the idea is that it's retesting of the lows is the idea. So and they will predict the price breakout to the upside under certain conditions, as we mentioned. So look, if you see the double on the left, if not, here you go. You can kind of see how the W is forming. So you can see the prices were higher, they go down, then they bounce up, and they go down and they bounce up again. So that's the idea of the W part of it. Now let's talk about how do we trade this. So we see a W, that's nice, but how does this really work, right? So if you see, we're starting with a downward trend. So over a double bottom, it's a downward trend and it's going to reverse is the idea. So you're going to hit bottom basically twice. Think of like those would be, we could have drawn a support line along the bottom, but you can see where the prices hit the first bottom, and then they back up into the middle of the W, and they reach a peak, and then they go back down to the bottom, forming the next side of the W. And Then after that, they go back up. So that's our double bottom, right? Once we've hit the bottom twice, we've now formed our double bottom. And what we're looking for is now it's going to hit that confirmation point. You could also call it a resistance line. If this was a rectangle, it would bounce off that resistance point and keep going back down and kind of trade with a narrow channel. But when we have a double bottom, it's actually going to break through that point right there after the second bottom. And that's your confirmation point. Once it's broken through there, a new trend is forming, and you use your upward trend type analysis, in a second touch, or you now have when we look at drawing trend lines. But the idea is that's your confirmation point that is broken through that top of the middle part of the W. You can see where I drew this line straight across, and then you're buying there after it's gone up above it a little bit, maybe over a period or 2 or 3, and you're now going to ride this uptrend. And it's very common for a pullback to happen then. So we've been on this long downtrend, hit bottom twice, broke through at the top, and now it's reversed from a downtrend to an uptrend. But there's a little bit of pullback, a little bit of profit taking, not unusual, actually very common, and it'll actually maybe dip below that confirmation point. But the idea is hang in there, because the idea is it's going to then continue with a double bottom. It's going to continue on that uptrend. It may just keep going on that uptrend, but having a pullback with profit taking is not unusual, and that's okay. Just be aware. So when we buy in there, we can then ride that uptrend up, and we can sell at the top there if we want to take a short-term profit. But the idea of a double bottom is we're maybe looking for that upward trend. So for a double bottom, there are some conditions to be met, some generally accepted conditions, and typically you're looking for a minimum of 10 days between the lows. Now it could be months, so this is a longer type of chart pattern. I suppose you could trade it over, shorter periods, but traditionally you're looking at days, so it's a day type trading over days, a minimum 10 days between the lows, so between those two bottoms, and it could be months if you're looking at longer patterns. And the variation between the lows is no more than 4%. They truly are within each other, very narrow, or very if you draw a line along the bottom there, they're very close to that support line. So there isn't it actually looks like a W. It doesn't look like something like a lightning bolt that keeps going downward. It looks like a W that's formed there. And then that center up move, is a minimum of 10% from the lower of the two bottoms, right? If it just goes up a couple of percent, you got this really funky looking W. That's not it, right? So it needs to move up 10% from the bottom and really form. It may not be a perfect W. Nothing. It's not going to look visually perfect, but it's going to look very clearly like a W. Is the idea. And then the price must move above the confirmation line. That's the important part of a double bottom chart pattern. It's got to break through that confirmation point to show a true reversal. Even though there might be a pullback later, it's got to break through significantly through that confirmation line. So you're looking for that as well. So when you're looking to trade on a double bottom, you need to make sure that these conditions are met along the way. But it can be a very powerful pattern to trade on. So if you took the letter W and you turned it upside down, you would have the letter M. And just like if you took a double bottom chart pattern and in effect turned it upside down, you would have a double top chart pattern. It would form the shape instead of a W, it would form the shape of an M. And a double top chart pattern is a strong uptrend that's, because it's a reversal, these are all reversal patterns, is now going to reverse and become a downtrend. So it's a very much the mirror image of a double bottom, just now we're looking at double top. And if you look at this, and you can kind of guess what might be the M here, and this chart here, there's some yellow lines that kind of help you see the formation of that letter M, and we're going to trade around that letter M. So let's put some more stuff around this so we can see how we would trade that pattern. So with a double top, you can see we have a strong uptrend going up. There might have been a pause there like it's shown here with some profit taking, but either way, there's a strong uptrend that's very much established. And then it peaks out in the first of the two double tops, that the first one there, you reach a peak and it turns around and really starts to go significantly back down. And then once it goes back down, it reaches a point of the lowest price there that then turns back around and goes back up to a top, forming a double top as it turns back around again, forming the letter M. So what we're looking for is we're looking for an uptrend. We're looking for, it's a really stop at a top there, or where a resistance line would be drawn, and then it's going to kind of come back down and form that letter M. And now our confirmation point is at the bottom of the, of the letter M, or in the middle part of the M at that low price there. And that's where if we had bought in before, we would be selling there. We would have confirmation that this is definitely a chart pattern that's a double top, and the double top is a reversal pattern. So maybe we had sold a little bit before, maybe taking our own profits, but if we want to hang in there, and once we see the double top form, then we definitely, and we break that confirmation point, you definitely want to sell it at that point. Because now we're going not from an uptrend, we're going into a strong downtrend. There may be some retracement or some, go back up the opposite way, where people are looking to, buy in. They might have thought, oh, it went down too far, we're going to buy back in and drive that up a little bit back up above the confirmation point. And what that does, it shakes out kind of the last hold-ons who see it, okay, it's gone back up a little bit, it's gone above that confirmation point. I'm just going to take my profit now because I just want to get out, because I know a double top is formed and I want to get out. So if I didn't get out before at the confirmation point, now is a good time to get out. And there's no guarantee there's going to be a retracement either. It could have just kept going down from here. But that's not unusual to see either. So the key on this is that you're taking a strong uptrend, is tried to go higher twice, didn't make it, went back down through the confirmation point of that middle part of the letter M, and then now it's done a full reversal and continues on down. And so you want to have sold around that confirmation point. Same thing as far as some conditions to be met. Again, mirror image of the double bottoms, but now it's the double tops. Like a 10 days between the lows. It could be months, but it could be, you're looking for at least 10 days between them. And the variation between the highs now is the no more than 4%. Again, it's not looking like something that's kind of the staggering steps upward or something like that. You're definitely forming that M, and so you want those tops to be within 4% of each other. So it really starts to look like that letter M. And the center move down, in this case, the center down move would be a minimum of 10% from the higher of the two tops. So think of whichever top is higher, you want, if they won't necessarily always be perfect, but there will be within 4% of each other, you want to be at least to have that middle part be 10% down. Then it's going to rebound back up to form the second top and then come back down. And then the price must move below the confirmation line to be a true double top chart pattern. So that confirmation line, if you haven't sold and taken profits before that, you might not have, and that's okay. You want to really make sure, if you're trading off this pattern, that the pattern fully develops. But once you see that confirmation point and breaks through, that's the time to sell at that point if you had bought into it and rode a nice uptrend yet and take your profits there. If it goes back and it goes above that confirmation line a little bit, then that might give you a second chance. But if it's a true double top chart pattern, it's a reversal pattern, and now the prices are reversing from upward trending to downward trending, and a very definite sell signal once you break that confirmation point. So if you like the idea of trading double tops, wouldn't the triple top be better? In many ways it is. So there's the thing called a triple top. In fact, it actually has its own name, which is a chart pattern is called head and shoulders, because it looks like a person's head with their shoulders. It is what the pattern will look like. So it gets its own special name other than the triple top. It's a head and shoulders. And you'll see these support and resistance breaks here as far as with head and shoulders and how that forms. And you'll see the trends as far as how those develop. And again, head and shoulders is part of the reversal family of chart patterns. So instead of a continuation of the trend, you're looking for the trend to reverse and go in the opposite direction that it originally was headed before it headed into this head and shoulder patterns. So if we look at this pattern here of our prices, and do you see a head and shoulders? That's a little trickier, but do you think of the top part maybe as the head, where you might put a face, and then do you see a head and shoulders? In fact, let's put a face there. There we are. We're happy with our head, and then you can see at the pointy tops, those are the shoulders, right? So that's the head and the shoulders. So numbers 1 and 3 there are the shoulders, and number 2 is the head, and you basically got 3 tops rather than a double top, right? 1, 2, 3. They're not all equal. You know how the double tops, they had to be within 4% of each other. So 1 and 3 would be within 4% of each other, but you have this kind of middle one that forms an even peakier or head on the triple top. That's why it's a head and shoulders, and it's rarer than double tops too, by the way. So this is why when you see head and shoulder, it's a strong indicator, because it's a very rare type indicator. And you can see we're in an uptrend coming into the head and shoulders, by the way. So you'd have a strong uptrend moving into it, and then forms this movement as a head and shoulder pattern. So how do we look at this? How do we trade on this? So if you look at it, you can see we've got the uptrend, and the confirmation line is in the head and shoulders is called a neckline, because again we're talking about body parts. So it's called a neckline. It also in effect is a support line, right? Our prices are going to bounce off it for a little bit before they break through. When the neckline is broken, that's when the pattern is completed. And you can see what's happening here is we have our uptrend, and we don't have a confirmation line yet, by the way, because we're just in this uptrend, but we reach this first part of the shoulder. In fact, that first shoulder on the left-hand side, if you're facing the person, you don't even know it's a shoulder yet, because the pattern hasn't fully developed, right? But you do know it's going down from that peak, down a little bit. So it's gone down. A new trend hasn't formed, but it's definitely some temporary downward price movement. But then it bounces back up and goes past that first shoulder and goes right up. Again, it's to what's later going to become the head. We don't know it's a head at this point either, because we might think, oh, it's just a continuation of the upward trend. We had a little pullback, now we're going back up, and maybe we'll keep going upwards. We don't know it's a head yet. But now it's reversed back down in forming this pattern, and it's come down and gotten within 4% of that neckline. So now we're looking at it, and we might say, oh, we might have a double bottom here, right? Because it's approached and hit that support line twice. But it's a little bit odder because we have that peakiness. A double top, or excuse me, a double bottom, wouldn't be as peaky well, it would. It'd form a W, but you could say a double bottom is forming actually. But it doesn't go back up. It goes up to the shoulder part, and that's where you've got kind of this triple top part, right? It's looking at it, and you can see the head, you can see the 2 shoulders, and when it makes that turn at that second shoulder, now you can actually see the pattern, and that's where you're really watching that support line, that confirmation line, and you're watching for it to break through that pattern. That would be the pattern is completed, and so that's what completes the pattern. So to be really ready to sell in this case, because it's an upward trend, you bought, let's say, earlier in the trend, and now you want to sell and book the profits that you had earlier in the trend before it breaks through that confirmation line, goes back into a true downward trend, and maybe starts eating away at all your profits. So that's when it's kind of fully formed on that, is the idea of a head and shoulder. It looks like a head and shoulders. You could do the opposite of that, which is called inverse head and shoulder. Maybe the person's like doing a handstand. But you can see on the far left, we're in a definite downtrend, and we can see how the shoulders and the head do the same thing where they form, but it's now the opposite way. So you have to kind of use your imagination to see that head, the peak there of the head and the 2 shoulders. And the idea of this pattern is this is a great buying opportunity, because the neckline, which is your resistance line, has been broken, right? It's tried to break through at the shoulders before. It didn't. In fact, in the middle, it had a big, deep drop. So this maybe was showing a pretty strong downtrend, but those shoulders kept touching those peaks. And when it tries again for that third time, so once it approaches the third time to that neckline or that confirmation line or that resistance line, that's basically your triple part of this inverse head and shoulder. Same thing with the head and shoulder. That's your triple part of it as well. And this time it's going to break through. And once we see that breakthrough, we're like, this is a true inverse head and shoulder, a rare pattern, but it happens. And once it breaks through, now we know we should maybe look at that. If an uptrend is fully forming, then we get in and we can now ride that uptrend going up. That's the idea of inverse head and shoulder. So you're trading the head and shoulder or inverse head and shoulder, depending on which way the reversal is going to happen, is the idea behind it.